This is Nightly Business Report with Tyler Matheson and Susie Gehring.
Moving higher, stocks finish on an up note, still on track for the best first quarter in 15 years, despite small losses for the week.
Water, not everywhere. How the ongoing drought is hitting Texas especially hard, and how it may get worse.
And too late or not, why there's still time to refinance your mortgage, but you may not want to wait much longer. All that and more coming up right now. Good evening, everyone, and welcome to our public television viewers. Susie, you know, stocks put their worries back on the shelf, at least for today.
Yes, that's the way it looked. Investors were back in the buying mood as stocks bounced back today, but still closed lower for the week. The Dow snapped its streak of 4 straight winning weeks, and the S&P 500 logging just its second losing week in 2013. Now, the market's got a lift on optimism out of Cyprus, combined with a batch of stronger than expected earnings reports. Here are the closing numbers. The Dow shot up 90 points, gaining back all of yesterday's losses. The Nasdaq rose 22, and the S&P added 11 points. Nevertheless, the S&P ended the week with a small loss.
And that good news coming out of Cyprus is that the nation may be edging toward a deal to avoid its banks from going bankrupt. The president of Cyprus will meet with European Union officials in Brussels tomorrow in order to beat a Monday deadline, which cuts off cash to the banks unless a bailout deal is reached. Well, stocks have had a great quarter so far. The Dow's up nearly 11%. In any year, that would be a good return. But our market guest tonight says there may not be much more upside from here. He's Stephen Wood, Chief Investment Strategist, Russell Investments. Mr. Wood, welcome. Good to have you with us.
Nice to see you again. How are you?
I'm great, thank you. You have a year-end target on the S&P 500 of 1550. That's actually 5 points or so lower than it is today. Where do you see the trouble coming from? Or have we just made all of our year's gains in the first 10 weeks?
I don't think that is a troublesome number. We have had a very good year, as you mentioned, very robust. You know, markets tend to have very choppy, very volatile patterns of returns. Some years, you know, you'll get a run up and a pullback, then a run up like we had last year. This year, we've had a very good first quarter. But even if we just hit the books and close them right now, it'd still be a good year. We think it's going to be volatile between now and the end of the year, but our numbers are based upon fundamentals, and the fundamentals haven't changed a lot. Sentiment, however, has. So we're seeing investors become more confident in equities. But that said, we do like equity markets, globally diversified multi-asset portfolios. Our clients are going to have to extend out that time horizon and hit a portfolio that really meets that goal that they're trying to accomplish over the next year.
I didn't hear you mention the word Cyprus once in that first paragraph or two of your thinking. Do you think that the worries over Cyprus are overblown or not?
Well, Cyprus as a specific entity, it's going to be overblown. I mean, it's very small. It's 0.2% of the EU. You know, forget the global markets, just of the EU. So it's very small. Cyprus has the potential to represent contagion. So if Cyprus, like Greece before, and it's much smaller than Greece, by the way, if that were to infect, let's say, Spain or even Italy, then it would become an issue. If it doesn't, it becomes very localized. I think the big issue in Cyprus that's very troublesome is they have their version of the FDIC, which is deposit insurance, if you've got less than 100,000 euros. Now, that's rule of law. And if they were to break that for financing purposes, that would be very different. So Cyprus right now, when you compare that to what's happening in the U.S. housing, which is positive, which may be offsetting what's happening in terms of what Washington has taken away by the tax increases and sequestration, it's a very small episode in the scope of things.
So let me just probe a little deeper as to why you think the market will be flat through the end of the year. Do you think that the level of profit growth just will not justify any real further expansion of the price-earnings multiple, or what?
Well, I would say with the first part, yes. If you look at profits right now, they're very strong, and they have been for a while, but it is a maturing earnings cycle. And also, in this environment, you know, the U.S. economy is growing more like 2% and a lot less than like 4%. In that environment, you know, pricing is going to be challenged, you know, so the top line, sales, is not going to be universal for all firms. It's going to be balance sheet by balance sheet, case by case. So security selection becomes far more important. So I'm sorry, go ahead.
I was going to say, as you you point out, the profit growth picture has been pretty good, but as you say, we're sort of getting at the mature point in that cycle, and I think the forecast for the first quarter is about 1 or 2% overall growth. But there are always ways that you can make more money than the index, or you can lose more money than the index tracking would lead you to believe. Where do you think the pockets of possible better than average profits would be between now and year end?
Sure. So we do like equities, and when you compare that to fixed income, which we find unattractive right now, certainly in government space, government bond space. So we do like equities. We like global equities. And again, it's going to have to be a multi-asset strategy, which is kind of all the above, looking at commodities, emerging markets, both debt and equities. Also looking in great companies in Europe, north of the Alps probably. But there are good companies with strong balance sheets in Europe as well. Looking into Brazil, Russia, Indonesia, Malaysia. So stock by stock, just grinding it out. So the yards are available. We just think they're going to be tougher yards. It's not going to be so much a risk on, risk off. But if I can jump off an earlier point you had, which was fantastic, which is the expansion of the PE or the multiple. What we've seen is that the fundamentals have not changed a lot, and that allows us to be a little bit more, flat from here until the end of the year. But sentiment is a very powerful thing. So if sentiment, if momentum picks up, if people become more confident and they like stocks, are willing to pay up for stocks, that could be rather strong. And we are looking at that right now. So if bonds are being sold to finance equities, that would change the dynamic, and we'd have to revisit our estimates for between now and the end of the year.
Stephen Wood, Chief Market Strategist, Russell Investments, thanks so much.
Thank you.
And coming up, we will get more specific and find out which stocks this week's Market Monitor likes.
Meanwhile, more warnings today that investors should get out of bonds. Billionaire investor Wilbur Ross says they're too risky.
We're recommending people not be in long-term debt of any kind, and instead we're urging our portfolio companies to borrow as much long-term fixed-rate money as they can.
Still, many investors feel safer with bonds, not stocks in their portfolios. But now there's reason to think twice about bonds. Here's why.
Buy low and sell high. Sounds easy, right? But it's tricky if you own bonds. When interest rates go up, the prices of your bonds go down. Not good if you're trying to sell them. Rates on the 10-year U.S. Treasury at record lows last July are now up more than half a point and are expected to go much higher, driving prices much lower. A scary thought for bondholders.
If the 10-year Treasury reverts back just to its average yield from 2000 through 2010, you know how much it will go down? 23%.
What happens next with rates and bonds depends on the U.S. economy getting stronger. And this man has been dropping hints on when that could happen.
Obviously, there has been improvement. Let me say that.
More improvement depends on the direction of unemployment and inflation.
As we make progress towards our objective, we may adjust the flow rate of purchases month to month.
For now, the Fed chairman says interest rates will likely stay very low into next year. But Bill Gross, who runs the world's biggest bond fund, tweeted otherwise. So the clock is ticking, and many experts say it's time to move away from bonds, especially the longer-term ones, because the longer you hold them, the more you stand to lose.
Tyler, it's all about interest rates, and we know that interest rates are important not only for bonds, but also for mortgage rates, right?
That's exactly the case. Falling interest rates for home mortgages has led to a recent boom in refinancing, but with rates bouncing just a little bit off their historic lows lately, many homeowners may be wondering if it's too late to get into the game. Sharon Epperson has some answers.
Fed up with the amount of paperwork and time it can take to process an application to refinance a mortgage, many homeowners don't even try. And the Federal Reserve's continued promise to keep short-term rates near zero hasn't provided much incentive.
I think there was an understanding by homeowners, well, why do I have to do it now and get all that documentation together if rates are going to move? So if rates are going to stay flat for the next 2 to 3 years, I think they think that there's an opportunity for them to refinance at a later date.
This may be part of the reason for the drop in the share of refinancing applications in the mortgage market, now at the lowest level since last spring. But many homeowners may not realize how much money they could save. Homeowners who could qualify but have not applied for lower refinancing rates are overpaying an average of $471 a month on their mortgages, based on an analysis by Credit Sesame, the consumer credit and loan company. That means, on average, households are potentially foregoing more than $56,000 in savings over 10 years.
Our analysis shows that in 2013, over 17 million households would qualify for refinancing at lower rate. Over 4 million households are expected to refinance. That means 1 out of 4 people are going to miss out on a refinance and saving opportunity.
To find out if you could refinance, check your credit score. If it's improved in the last few months, you could qualify for a better interest rate, especially if your score is 740 or higher. Even if you've lost equity in your home, you still may be eligible for the government's Home Affordable Refinance Program, as long as there's no second mortgage and your current loan, backed by Freddie Mac or Fannie Mae, is less than 80% of the value of your home. Has your income dropped? As long as you have some income and you've managed to stay current on your loan, you also may qualify for a HARP loan. But to be sure refinancing makes sense, you need to figure out how long it will take you to break even. How long will it take your total monthly savings to exceed the closing costs? If you plan to stay in the house at least that long, then refinancing likely makes sense. For Nightly Business Report, I'm Sharon Epperson.
Turning now to our market focus, we begin with Blackberry. Well, no champagne rally for the rollout of Blackberry Z10 smartphone. Despite all the hype, consumers and investors didn't buy in. Early in the day, shares were up by 4%, but as investors got word of no lines at AT&T stores and no first-day buzz about the phones, the make-or-break day broke. Blackberry tumbled almost 8% to $14.91. Well, a much different day for Nike. Shares soared, touching an all-time high. Nike was the best performer in the S&P today. Investors snapped up shares, reacting to a 55% jump in net income that we told you about last night. Nike ended the week at $59.53, up more than 11%. Well, after Nike, Micron Technology was the second best performer in the S&P. It reported a huge jump in sales of memory chips that are used in computers and cell phones. And the company is expecting another double-digit revenue increase in the current quarter. Micron shares closed at $10, up more than 10.5%.
And Tiffany shares rose, even though earnings grew very modestly, less than 1%, but that was better than most analysts had expected. Tiffany maintained its full-year guidance, saying the pace of growth would pick up again this year, with Asia leading the increases. Shares closed up more than 1.5% at $69.23. At the other end of the spending scale, Darden Restaurants, a barometer of consumer spending. Darden reported earnings in line with analysts' reduced estimates. Darden operates Olive Garden. Red Lobster said its customers were impacted by higher gasoline prices and by that payroll tax hike. Still, shares closed at $49.62, and that was a gain of about 1/3%.
Our Market Monitor guest tells investors to circle July on their calendars. That's when he says stocks will pick up big time. He's Phil Orlando, Chief Equity Strategist at Federated Investors. So, Phil, let's start out talking about July. I mean, what's the catalyst for a pickup in the markets?
Well, from an economic standpoint, the economy has been relatively sluggish the last couple of quarters. Fourth quarter was barely positive. First quarter is going to be sluggish as well. To some degree, Hurricane Sandy has been, in our view, taking 0.5% or so out of growth. But as we get into the spring months, that's going to result in an economic pickup based upon the rebuilding. We think a lot of the noise relating to Washington is starting to fade. The fiscal cliff, the sequester, the debt ceiling, all of those issues seem to be moving out later into the year. So as a result, the impediments that were slowing the economy down over the last couple of quarters, we think is going to result in better economic growth in the back half of the year. Now, the equity market, as a forward-looking discounting mechanism, is starting to sense that. And I think to some degree that's one of the reasons why the market's ignored Washington and ignored Sandy so far this year and is up 10% or so in the first quarter. And that's why you have such a bullish forecast for the S&P. You're calling it for to end the year at 1660. Right now it's at 1555. So it's all going to play out
pretty strongly through the end of the year, right?
Well, and we think corporate earnings will chug along, mid-single-digit increase, maybe about $108 full year for the S&P. We think we'll get a little bit of multiple expansion, maybe from 14 to 15 times as Treasury yields continue to work higher. That will drive some disintermediation out of bonds into stocks, and we think the equity market ends up with a sort of 15 to 20% positive return for the year.
Okay, that's really a good way to now turn to some of the stocks that you think are going to perform well over the next couple of months. You have Lennar, L-E-N, on the big board as your top pick here. You know, it reported these blowout earnings this week. The stock has been on a tear. Is there still room to grow?
Well, the stock has tripled over the last 18 months or so, but we are in the early stages, maybe year 2, of what we think is going to be a 6-7 year recovery in housing. We've got a lot of ground to recapture, a huge hole to dig out. We think Lennar is one of the companies that's best positioned. When it reported earnings the other day, they reported an 80% backlog for the next year. That's well above what anyone was forecasting.
Let's get to your other picks. Ford, tell us what's the traction there.
Well, we think the auto market, like the housing market, has a lot of catch-up to play. Now, Ford is an interesting play because not only is it going to recover based upon the rebuilding or the restocking of the auto fleet in this country, but it's also a quasi-housing play. The area that is most attractive within Ford is their pickup division, the sort of cars that the contractors are buying. So if we're right that the housing market's going to continue to do well, and if we're right that the auto market's going to recover, then Ford and their pickup division is one that's going to work.
All right, let's get your next pick, Oracle. A real surprise because that stock got hammered this week. You were buying shares yesterday. Tell us, what are you seeing that other people are not?
Well, very controversial pick. The stock is down 10% or so since the earnings report earlier in the week. We think that the software portion of the technology cycle is sound. What's going on at Oracle from a fundamental standpoint we think is fine as well. Margins are fine. The issue exclusively was the fact that they missed on revenues. And the problem was that a lot of the sales that management expected to hit in the third quarter slipped into the fourth quarter. We think that they're going to get back on stream by the end of the fourth quarter. We're expecting a good quarter. And as we look out over the next year, we think the stock is still going to trade into the upper 30s. So with the stock down 10% here over the last couple of days, we thought that that was an attractive entry spot.
All right, Phil, great information. Any disclosures to make?
We own all of those 3 stocks in our funds.
All right, fair enough. Phil Orlando, Chief Equity Strategist at Federated Investors.
Thank you, Susie.
And still ahead, the fallout from the government's budget cuts could be coming to an airport near you. But first, take a look at how the international markets closed out the day.
Today is World Water Day, but you wouldn't know that in many parts of the U.S. The drought in the nation's midsection is entering its 3rd year, and more hotter and drier weather is expected this spring. Now, one of the hardest hit states is expected to be Texas, where rice farmers who need a lot of water for their crops are feeling high and dry. Bertha Coombs has more.
Ron Gertson spends more time maintaining his combine than using it for planting. Rice farmers in southeast Texas aren't getting water from state reservoirs.
For the first time in the 72-year history of our getting water from the Colorado River and from the lakes upstream, we've been cut off, and it's 2 years in a row.
The Lower Colorado River Authority has prioritized water for cities rather than heavy-duty irrigation use. With a crippling drought now in its 3rd year, it's a problem for farmers statewide.
These are heavily agricultural areas where water problems are growing and will only get worse, especially as we have cities competing for those same sources of water.
Part of the reason farmers are lower in the pecking order is that cities pay higher water rates.
But with 90% of the state in extreme dry or severe drought conditions, the state climatologist says if there's no relief this summer, other industries could also feel the pain of restrictions.
Most water supplies did not have to go to the really severe restrictions a couple of years ago during the drought because we started off with plenty of water. This time around, we may be hitting some new territory where we start seeing some stage 3 and stage 4 restrictions, which would essentially mean only use water for the stuff you actually need water for. If a plant goes dormant, let it go dormant.
Gertson invested in a new well to source some water, and crop insurance should offset losses again this year. But brokers have warned this is the last year. His plan if the drought continues?
We're praying.
And not just for his farm. Bertha Coombs for Nightly Business Report.
Another crisis, $1 billion budget shortfall has forced Chicago to shut down 54 public schools at the end of the school year. The closures would save more than $500 million over the next decade. A final vote by the school board on those closures will take place in May. Meantime, the Chicago Teachers Union is planning a protest march over the proposal next week.
Meanwhile, billions in automatic spending cuts approved by Congress have prompted the Federal Aviation Administration to cut funding to staff air traffic control towers. The cuts impact 149 local airports all around the country. Hampton Pearson is live from one of those airports in Maryland. Over to you, Hampton.
Hi, Susie. You know, it took Frederick, Maryland about 10 years to get federal money to build the brand new control tower behind me. Now, just 10 months after it opened, it's a budget cut casualty. Less than a year after it opened, the $85 million air traffic control tower at the Frederick, Maryland airport, paid for in part with federal stimulus dollars, is now a casualty of the automatic sequester budget cuts.
In 2010, the federal government awarded us $5.3 million to construct the air traffic control tower because it was needed for safety. And then fast forward to 2013, now they're saying it's not needed for safety. So it truly is the world of mixed messages.
The FAA announced today it's closing 149 airport control towers across the country as part of an overall plan to save $637 million. But aviation advocates argue the FAA is putting dollars ahead of safety.
The reason these towers are here was number one, safety, and number two, to help the efficiency of flight operations.
Airports like this one in Frederick, Maryland will remain open, but without its air traffic controllers, it'll be up to the pilots themselves to sequence their takeoffs and landings. As for the controllers, they are out of their jobs.
I've been working on my resume. I'm looking at some schools to maybe get some VA training, but to start out at the beginning, at 51 years old is daunting, is scary.
And Todd Johnson and controllers like him nationwide at those 149 facilities set for a shutdown have about 3 weeks to begin to adjust to their new reality. Back to you.
Oh, that is a big new reality. Thanks a lot, Hampton. And if you want to find out if any airports in your area are on the list, just head to our website, nbr.com. And coming up, could the minivan go the way of the dinosaur? We'll tell you why sales have stalled. But first, let's take a look at where commodities, treasuries, and currencies closed out the day. The makers of minivans need to check their rear view mirror. Crossover utility vehicles, or CUVs, like the Subaru Outback or the Honda CR-V, are in the passing lane and poised to overtake the family-friendly minivan in sales. Phil LeBeau tells us why the minivan sales have stalled.
Wow, it's very peppy.
Ron Horing in Naperville, Illinois, is the new face of America's growing love affair with crossover utility vehicles, or CUVs.
My wife loves it because it gives her a much higher point of view than...
Horing recently bought a Ford Escape so his family will have more room and can carry more things when driving around town.
It has the ability to haul cargo. You can throw seats down. You need to go to Home Depot, get a plasma screen, whatever you got to do, it's whatever. It all fits.
In the past, Horing and others seeking cargo space might have bought a minivan. But increasingly, buyers are turning to crossovers and sport wagons as smaller, better options. This year, minivan sales are down 10%, while overall industry sales are up 8.4%, and sport wagon crossover sales are up 15.2%. Why are the sales of crossovers and SUVs continuing to increase in the United States? Mainly because there are more choices than ever before. So people who used to be in the market primarily just for a minivan now have more options when they hit the showroom.
Well, I think people don't necessarily like the minivan stigma, that they're not comfortable saying they can drive a minivan, when in all reality they can get an SUV or a crossover SUV that suits their needs.
Strange as it sounds, minivans have become niche vehicles. In 2000, more than 1.3 million were sold, and minivans made up almost 8% of all auto sales in the U.S. Now minivans make up just 3% of the market, and just over 500,000 were sold last year. The big fall from the late 80s, when America fell in love with the minivan.
Parking is simple. Getting in and out is easy.
Well, I think over the last decade, we've really noticed a big change. Minivans back in the day was the soccer mom. Everybody had to have one. Minivan was such a large segment back then. Nobody thought vans would have gone away.
It's not extinct yet, but the minivan is no longer the only symbol of suburban America. Phil LeBeau, Nightly Business Report, Chicago.
My wife, I proposed a minivan to her. I didn't propose with a minivan, but I proposed one to her. She would have no part of it.
I'm with your wife. But I do like these crossovers. The Ford Escape, I've rented it, and like Phil said, women like to feel like they're ruling the road. Yeah, I like that.
It's they're very convenient. I have a Chevy Traverse, which is one of those bigger SUVs. All right.
Anyway, that's it for us. Nightly Business Report for tonight. I'm Susie Garrett. Have a fabulous weekend, everyone. You too, Tyler.
Oh, you too, Susie. I'm Tyler Matheson. Thanks for being with us, and we'll see you back here on Monday. Have a great weekend.
I'm Susie Garrett with a Nightly Business Report news brief. Stocks rebounded today, but still closed lower for the week. The markets got a lift on optimism about a bank bailout deal in Cyprus and a batch of stronger than expected earnings from Nike to Tiffany. On Wall Street, the Dow shot up 90 points, gaining back all of yesterday's losses. The Nasdaq rose 22, the S&P 500 added 11 points. Blackberry's make or break Z10 smartphone went on sale today at AT&T stores, but consumers and investors were not impressed. Shares fell nearly 8%. And billions in automatic spending cuts approved by Congress prompted the Federal Aviation Administration to cut funding to staff air traffic control towers. 149 local airports around the country are affected. And be sure to tune into Nightly Business Report right here on your public television station.